Hi, and welcome to this week's episode of Tackling Your Taxes, which is a series by Mid-Minnesota Legal Aid's Low-Income Taxpayer Clinic about tax issues that impact Minnesotans, um, about different issues like this week's claiming dependence on your tax return. My name is Aisha Sarvati, and I'm the clinic director of Mid-Minnesota Legal Aid's Low-Income Taxpayer Clinic. And I have Georgina with me, who is a law clerk with the Low-Income Taxpayer Clinic, who will be presenting on this topic. So I'll hand it over to Georgina.
Hi, everyone. To get us started, we're just going to do a quick overview of who are dependents and what are the benefits. So a dependent is someone other than the taxpayer who relies on the taxpayer for financial support. And some of the benefits of being able to claim a dependent are just that it opens doors to certain tax credits and deductions that could increase your tax refund. So some general rules, and these are going to vary a little bit based off of which credit you're going for, but generally speaking, a dependent needs to be a U.S. citizen, resident alien, or resident of Canada or Mexico. You cannot claim a dependent on more than one tax return, and a dependent cannot claim someone else as a dependent on their own tax return. So basically, a dependent can also have a dependent. You can't claim your spouse as a dependent if you file jointly with your spouse. And a dependent must either be a qualifying child or a qualifying relative, which we're going to touch on next. So a qualifying child needs to meet a few requirements. So they must be a son, daughter, stepchild, eligible foster child, brother, sister, half-brother or sister, stepbrother or sister, adopted child, or a child of any of those previous relationships that I just mentioned. The child would need to be under 19 or under 24, but if under 24, they need to be a full-time student, or any age if they are permanently and totally disabled. Also, this qualifying child would need to live with you for more than half of the year. They also need to receive over half of their financial support from you, and this person could not file married jointly unless to claim a refund of taxes paid or withheld. Next, a qualifying relative. So a qualifying relative is a little different. They cannot be your qualifying child or the qualifying child of another taxpayer. So you can't claim someone as your qualifying relative and then have someone else claim that same person as their qualifying child. This person needs to live with you the whole year as a member of your household or a specific type of relationship. They need to have a gross income under $5,050 and need to get more than half their financial support from you. So a question that comes up a lot is what happens if both parents want to claim the same child on their tax return? So there's a few rules we can use to determine which parent is going to claim the child. So the main rule is that the custodial parent is going to be the one that claims the child. So that parent is the parent who the child has lived with for the greatest number of nights during the year. If the child has lived with each parent for an equal number of nights, then the custodial parent is the parent who has the higher adjusted gross income. And another rule is that if only one of the persons trying to claim the child is the child's parent, then the child would be treated as the qualifying child of the parent and not the other person. So getting into when you can actually claim a dependent and start receiving some of these benefits. A few examples are here: the child tax credit, adoption expenses, the additional child tax credit, credit for other dependents, the earned income tax credit, child and dependent care credit, the education credits, medical expense deductions, and certain other itemized deductions. We're going to take a closer look at a few of these, but the IRS has really great resources online as well if any of these other ones seem interesting and you want to look into them further. So first up, we have the child tax credit. The child tax credit is going to help families who have qualifying children receive an increased refund or decrease what they owe the IRS. So the child must be 17 at the end of the year and have a Social Security number. Something to note with the child tax credit is that the amount you receive begins to decrease if you individually make $200,000 or if you're filing jointly and together you make $400,000. The max amount of the child tax credit per child is $2,000. Another item that's important with the child tax credit is that it's a non-refundable credit. So that means that it can reduce your tax liability to zero, but it can't result in a refund if the credit exceeds the taxes owed. So it can bring your taxes to zero, but won't refund you any back if it exceeds what you owed. And in order to claim this credit, you need to fill out your Form 1040 and attach a completed Schedule 8812, which is credits for qualifying children and other dependents. I included a link here, but also these are available on the IRS website with more details as well. So this is the additional child tax credit, and it's not a separate tax credit. This is an amount that a family can receive as a refund if the child tax credit exceeds what you owe the IRS. So what I previously mentioned about the child tax credit being non-refundable, the additional child tax credit is refundable. So it's the excess amount after the child tax credit limit is reached. And the max additional child tax credit is going to be $1,700 per child. In order to claim this credit, you follow the same steps as for the child tax credit. So fill out the 1040 and then attach a completed 8812. But specifically note Part 11A, that's where you could fill out for the additional child tax credit. Next up, we have the adoption credit. So this is really helpful. If you'd adopted an eligible child, you can claim this credit on your federal income taxes for up to $16,810 in qualified expenses. That was from 2024. The amount for 2025 may have changed. And certain expenses that you can claim for this credit are adoption fees, attorney fees, court costs, travel expenses, essentially the costs that go into the adoption of a child. And the child that has been adopted must be under 18 years of age or physically or mentally incapable of caring for themselves. And this credit is a non-refundable credit. So again, this is the kind of credit where it can bring your tax liability to zero, but it can't, you cannot get back more than what you owe. And in order to claim this credit, you'll fill out a Form 8839, qualified adoption expenses, and then attach it to your 1040. Additionally, we have the earned income tax credit. So this is going to help low to moderate income workers and families get a tax break. You can use this credit to reduce the taxes you owe. A few of the qualifications are to have earned income. So this can be any kind of earned income, but you have to have earned it by working somehow. You also need to have investment income under the limit, have a valid Social Security number, be a U.S. citizen or resident alien for the entire year, and you cannot have filed a Form 2555, which is for an earned income. And to claim this credit, you'll complete the IRS Schedule EIC, and that'll be just filed with your 1040. And there's a few further qualifications that you can review on the IRS website. This is a credit that can get overlooked, but it can be really helpful for families who qualify. Child and dependent care credit is a credit where your income, your tax may be reduced for child and dependent care expenses on your tax return. So in order to claim this, you and your spouse, if it's a joint return, must have earned income during the year to claim the credit. And people you can claim as having received care are a dependent if they're under the age of 13 when care is provided, or your spouse if they're unable to mentally or physically care for themselves or live with you and for over half the year. A person is unable to take care of themselves and lives with you for more than half the year. And that must either be a dependent or someone who would have been a dependent, except for some of the income provisions that would have made them a dependent. In order to claim this credit, you need to complete a Form 2441, which is the child and dependent care expenses, and submit that with your 1040. Next up, we have the education credit. So there are two different education credits available. That's the American Opportunity Tax Credit, which is a refundable credit, so you can get back more than what you owe in taxes. And then the Lifetime Learning Credit, which is a non-refundable credit. There's more specific rules for each of the credits that are available on the IRS website, but you must meet the following to qualify for either of these credits. So you, your dependent, or a third party must pay qualified education expenses for higher education. An eligible student must be enrolled at an eligible educational institution. And the list of those is available at this link. And it's fairly easy to find on the IRS website under the education credits. And then the eligible student must be yourself, your spouse, or a dependent that you've listed on your tax return. And you must have received a Form 1098-T from that institution. In order to claim this credit, you'll fill out the Form 8863 and attach that to your 1040. All right, last up, we have a few helpful resources. We gave you an overview in this presentation of a lot of the credits for dependents that can help you receive some benefits with your taxes. This is a list of places you can go to find more detail about each of the individual credits I mentioned. Also, we have listed our intake line at Mid-Minnesota Legal Aid. If you have any tax issues or other civil legal issues that you may need assistance with, you can call that line and they can help determine if we might be able to help you with some of those legal issues. Thank you for listening today, and I hope you learned something about claiming dependents on your tax returns.
Thank you, Georgina. We'll just take a couple moments to see if any live questions come in, but otherwise, this presentation will be has been recorded and will be available on MMLA's social media. One thing to note is that the Low Income Taxpayer Clinic is a statewide program. So if you have any, tax issues or tax questions, you can call our intake line, regardless of where you are in the state, and you'll be connected to us. We do represent low-income taxpayers, but we can give advice to anyone regardless of income. So we encourage everyone who might have a federal tax issue to contact us, and then we can evaluate whether we can offer any services. So that is this week's Tackling Your Taxes episode. We will be doing another episode next Monday. And that will be the last one for a little bit. And then we'll pick back up in a couple months with some additional issues about getting ready for tax filing season. So thank everyone and have a good day.